Welcome back everyone to another episode of Small Business Treasury. And today I have a very good question that I want to answer in today's video. And the question is, how many people should have access to the bank account within the organization? And that is a fantastic question because it's not a straightforward answer, but there are ways to have additional protection within your organization depending on how many people have access to the bank. But depending on the corporation size, it's going to be dependent on how many people have access, right? So at a large corporation, at the company that I work for, we have, I believe I manage about 165 users across the entire organization, our finance team. And it's my job and responsibility to assign certain rights and access to each of those users. It's my responsibility to go in there and deactivate users when someone resigns or when someone retires. It's my responsibility to go in there and making sure that nobody has additional accesses that they shouldn't need, right? So at our organization, we have over 100 bank accounts, all right? So within our main banking platform, and depending on the bank account, that's usually the way we structure our organization is that the bank account is tied to the business unit. So as you can see, we have about 75 business units or subsidiaries within our organization. Each of those have their own bank accounts, and some of them have multiple bank accounts. That's why we have over 100 bank accounts and closer to 125 across the entire organization, but over 100 bank accounts within our main banking platform, right? So each one usually represents one subsidiary, one bank account. Some of them have multiple bank accounts, and across that you have 165 users, right? So that typically has on average 2 to 3 people per business unit or per subsidiary, and each one is going to have different access rights, different entitlements, different types of functions, different types of abilities, different types of user settings, etc., right? So depending on the organization size, depending on how you structure your organization, is going to depend on how many people have access to the bank accounts. But that's also proved for you as a business owner as to show you is you shouldn't be afraid of having a lot of users within your organization as long as you have good practices in place and as long as you have good policies in place, right? Because as long as your treasury department functions properly, then you shouldn't have to worry about the amount of people who have access to the bank account because everything is separated properly. Everything is written down properly. The policies are in place. But most importantly, the treasury practices and protocols are in place. All right, making sure that no one has dual approval, making sure that no one has the ability to initiate, approve, and release, making sure that someone only has certain access to certain bank accounts, making sure that nobody has the ability to do anything without manager approval. All of these things are implemented when you add dual approval procedures within your organization using the TMO at your local bank, your treasury management officer, which is the individual responsible for implementing treasury services within your organization. Okay, so if you structure things properly, you shouldn't have to worry about how many users have access to the bank accounts because that's the whole purpose of Treasury. The Treasury department is there to make sure that whenever you are scaling your organization, you're able to scale safely, you're able to scale confidently, you're able to scale without worrying of any type of embezzlement, fraud, any other types of problems that may arise at the smaller level with smaller organizations, at growing companies. All of these things are there in place to make sure that you're protecting the capital that is within the organization, right? So going back to the question of how many people should have access, well, that depends on the organizational size. However, the solution usually isn't on the amount of users, it's typically in the settings that they have. So the most common structure that we encountered within various corporations across the entire various industries and different sizes, the most common structure is there's a 3-step process. There's usually an initiate, an approval, and release structure for any type of electronic payment, whether that's ACH or wire payment, okay? And that's applicable to cross-border wire payments as well. So the typical structure that you'll have is that you'll have an individual, typically an analyst, an entry-level position, who initiates a payment. They initiate the payment, Maybe it's for an invoice for a vendor. Maybe they need to issue a manual payment to a contractor, 1099 to an employee or a vendor, whatever the scenario may be, they have to issue a payment. Okay, so you have the AP individual who has access. They log in as normal, but they only have access to initiate payments. And they may only have access to a certain amount of limits for ACH payments. So you can cap their ability to maybe $25,000, $50,000, $100,000 in limits when issuing payments. Okay, now the issuing payments is not a big deal as long as you have good practices in place where you have dual approval, which is the ability to have multiple people sign off on a single electronic payment. Okay, so if you have someone who initiates, you have to have someone who approves and release. Okay, so whenever that structure is set up properly, you can have an AP specialist or entry-level accountant or a staff accountant go in there, initiate the payment, and then they send it to their manager for approval. And the manager will go in there, review the invoice, they'll review the payment, they'll review the banking details, whatever structure you have in place, whether you're using ACH templates or wire templates. I highly recommend they use that. You don't use freeform. Freeform creates a lot of human error. Okay, humans make mistakes, and every time you issue payment, every time you have to issue a payment, and then you have to put the banking information over and over again, that creates a lot of problems. That creates the ability to make human error. So we usually recommend always use ACH templates and wire templates every time you issue a payment, whether that's a one-time payment or recurrent payments, but especially for recurrent payments. Anyways, once the payment has been initiated by the AP specialist, the accountant, the staff accountant, you'll have the manager that go in there and they'll sign off on it. They'll sign off on the transaction, they'll approve it. And at that point, corporations have two options. They can have the manager also release, or they can have the AP individual go in there and release after the manager approves. Both of them are okay. The most common practice that I've seen is that AP specialist initiate, manager approves, and the AP specialist releases the transaction. That's the most common practice that I've seen. It's very safe. It's not, you have dual approval. You have multiple people involved in the transaction. You have a manager who signs off. Everybody is aware of the transaction. You have certain limits available if it's applicable to your organization. That creates a good safety net, right? The problem exists when someone has the ability to initiate, approve, and release all within the same organization, the same function. And that creates a lot of opportunity for embezzlement. That creates a lot of opportunity for fraud to occur. That creates a lot of opportunity for, or not opportunity, but exposure to fraudulent activities. All right. So you want to reduce that risk as much as possible by implementing dual approvals and dual controls. That's a feature that is offered by your Treasury Monitoring Officer at your local branch. You know, sometimes these TMOs operate locally, sometimes they operate within a region, sometimes they work out of a downtown office and you have to implement it through them. Treasury is not really something that every single local branch is gonna have access to. That's typically escalated up to the corporate level, so you have specialist individuals who work with this team of Treasury specialists to implement Treasury services within your organization. But they are there to help you to implement these things and walk you through. You just have to be careful that they're not selling you on items that are unnecessary for your organization. You know, the most important aspects for growing companies to make sure they're implemented early on is dual controls, ACH fraud filters, wire fraud filters, check positive pay, multiple user login with MFA and RSA logins, credit limits, not credit limits, but ACH and wire template limits, payment limits, right? These are the most common, the most important to protect your capital when you have multiple people logging into the banking portal, and you want to avoid as many as exposure as possible by adding certain level of protection, by adding additional steps to protect that capital and need, right? So as you as a founder, CEO are responsible to make sure that these things are implemented. Then you have your C-suite, your CFO, who should be aware of these and to enforce policy, okay, and to police these things within your organization. Okay, so that's the important thing when it comes to how many users have access to the bank accounts. The question is how many users are acceptable. That's not the question, because you should be focusing, do you have good practices in place to make sure that when you have multiple users have access to the bank accounts, do they have certain restrictions that allow them to always seek dual approval, always making sure that they're operating within healthy boundaries of limits of payments, making sure that you have good policies in place to protect for any changes when a new vendor requests change for banking information, right? These are all important steps whenever you're setting up the treasury department within your organization. And again, a growing company may not need a full dedicated treasury team, but the accounting team who is responsible for the banking platform should definitely be aware of good treasury practices. You don't need to have a treasurer in your organization to have these implemented. You should be implementing these the moment you start hiring accounting staff. Okay, because the accounting staff in the beginning, whether it's a small growing business or a larger corporation who starts reaching several $million in revenue, you start to notice that they have access, and if you're not aware of the access that they have, you're not aware of the exposure that your capital is at risk, right? I'll give you an example. If you have $250,000 in your checking account and there's a single individual who has the ability to initiate, approve, and release transactions, all of that capital is at risk, especially if there's no limits and no dual approval processes in place. I've seen this happen multiple times in other corporations and other companies. There was a smaller corporation who was doing a couple $1 million in revenue. They had a CFO who had full access to the bank account, and the CEO is so busy trying to scale and grow the business that they're trying to generate new revenue, they're trying to create new sales, that they trusted the CFO to be able to handle things properly, to issue payments, to issue payroll, to work with vendors, to set up new vendors, okay? And later it was discovered that the CFO was siphoning off fake invoices and sending them to their personal bank account. Embezzlement, right? That happens many times. That happens more often than you think. If you go look at famous content creators, right, there's a certain individual in particular that they've said, oh, early in my career I was screwed out of my money because my partner took half the money and left. That's very common when you don't have dual approval processes in place. I had a friend who started their business early last year. Okay, he started with a business partner. It was two of them, and they both had access to the bank account. The other business partner was very adamant and be like, no, I want to have full access and visibility to the bank. That's my department. I'll act as a CFO, blah, blah, blah. And then my friend, who trusted him to operate in good ethics and morals, said, okay, that's fine. We're in partnership together. You can oversee the bank accounts. Not a big deal. And they were making pretty good money. They were making a couple $100,000 a year, right? So this is a startup making a couple $100,000 a year with a handful of individuals on their team, two founders, and a handful of individuals working for them. Okay, making a couple $100,000. It's not a small business at that point. It's early. It's an early startup, but you're generating a couple revenue with very minimal overhead. So your net profit margins are very, very high. At that point, you should definitely be having good treasury practices in place. Anyways, long story short, it turns out that the business partner was embezzling money. That they were taking money from the company and they were spending it on personal items. They were buying gifts for their wives. They were basically loaning that money to themselves with the hopes that they will pay the company back. Right? That right there is an example of how that could have been prevented by having good treasury practices in place. Just because a corporation's at small scale or at the early stage or the startup phase does not mean that you don't need to have treasury services within your organization. And let's stop focusing on the word treasury because it's a corporation word. Treasury is simply cash management, visibility, liquidity, solvency. Anything related to the banking platform, anything related to wires, checks, ACH, that's all treasury. So your corporation's operating using treasury tools on a daily basis, but most people are not aware of the terminology because it's a corporate language. But treasury is the simple practices of anything related to banking and payments. So your corporation from day one is operating at a treasury level, just depending on the size of it, is how far you want to implement it by having a dedicated team. But every organization has a treasury function within their organization, because every corporation has payments and every corporation has receivables. And we just saw the example that, two founders at a very small scale generated a couple $100,000 in revenue. They were already having bad business practices, and my friend was a victim to that. He was a victim to an individual who was embezzling money from the corporation. All right. So you, as a founder, as CEO, you want to make sure that you have these policies in place. You want to discuss with your CFO to make sure that he's enforcing these policies, right? But it's your job as a founder, the CEO, to go speak to your local branch, making sure that you implement good treasury practices and tools within your organization to protect the capital. Okay. A $25,000 loss for a major corporation is nothing, but a $25,000 loss for a startup is a lot of money. That's your expansion fund. That's payroll. That's your next big project, and then scale it upwards to 2.5 million, 25 million. The practices are the same, whether it's a team of 2 or a team of 200. I've been in corporations where the treasury team is just 2 people. And I've been in corporations where the treasury team is 6 people, 7, 8, 9 people. Okay, so that's the difference between small corporations and large corporations, is that we think that because we're small, you don't need to implement these things into your company. But that's a misconception. The earlier you start implementing treasury practices and policies, the more you're going to be able to protect your capital, the more you're going to be able to sleep at night, the less you have to worry about people stealing from you. If my friend would have had dual approval for every transaction within the treasury function, within the organization, he would have been a victim to fraud from his business partner, right? They would have prevented embezzlement. That means that every single transaction that left that bank would have required 2 signatures, digital signatures, because they had dual approvals in place. And he came to me after the situation happened. I told him, yeah, man, you could have prevented all of that. You could have prevented all of that by having dual approval, dual controls, to make sure that whenever a transaction leaves the bank account, that you have multiple people signing off on it. Anyways, that's all for today's video. If you have specific questions you want me to discuss in these videos, send them to my Instagram, send them in the comments, send them to my email, and I'll do my best to make a video specifically for that question. And I want to help as many small business owners. I love doing this, as I'm very passionate about it. I come from a family of small business owners, so I want to help those individuals as much as I can. I have over 10 years of corporate experience. If you want my help directly with your particular situation, I can almost guarantee that if there's a problem that you're facing that I've encountered in my career, and I know the solution to it. So you can work with me directly. You can put them in the link. There's a link in my bio, so we can go ahead and tackle those problems. But that's all for today's video, and I'll see you on the next one.